Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Probably the decent statement that I'd have to share, the difference between a professional and a novice trader is professionals don't hesitate, they act. I always tell people, listen, if you get out of the trade, you can always get back in. The hard part, most people tell me, is it's hard to get back in. Well, it really isn't if you know what to look for with the right education. A professional trader, guys that have been on the floor, they don't care whether they're selling the whole or buying new highs. In fact, most great traders that I've ever met, they love buying new highs. Buying new highs and selling new lows makes men very wealthy and wise. So follow that mantra. We don't look to catch the falling knife, as you heard. Just like with that buy signal, we waited for the market to confirm a reversal. There were some nuances that took place between price and moving averages, and then we said, okay, this is where we need to get in. What's our risk if we're wrong? Or the market condition would change. Market condition meaning, what if we get two ranges closing back below the moving average? That's a change in condition, right? So therefore, there are ways that you can look at trading these markets. So most traders have a real hard time making fast decisions under pressure while examining price relationships to moving averages. And that's why we can develop these signals that you can type out and write your criteria out and then have indicators that pop up and say, boop, your criteria has been met. Then what you need is, of course, some trade management techniques to determine your entry, whether you're going to go at the market, whether you're going to buy a pullback, whether you're going to use market order, limit order, whether you're going to use options, or whether you're going to use underlying derivatives. That's what you need to do. And many people would say, well, then I'll also look for scale outs, or maybe I'll look for scale in or add-on positions. So there's several different ways that you can look at trading. And the technique that I've just walked you through today is obviously something that you can implement in all of these types of areas for your trading. Now, several time considerations include lining the moving average with specific time frames. That's another thing, a big question I'm sure some of you are going to ask me. What are those time frames on that moving average? What was that time frame? Well, you need to go out and find the moving average that best suits the market that you're trading. A moving average on John Deere might be a little bit different than a moving average on Apple, for example, okay? A moving average on the British pound would certainly be a little bit different than a moving average on, say, the Australian dollar. One has a little bit more volatility and price swings than the other. So you have to experiment with your parameter settings, your time settings, all right? If you're using on a weekly basis or a daily chart and you use 5 on a daily chart, that would equal what? 5 days, which is a 1 full trading week. If you're using a daily chart and you say, okay, let me compare a 10-day versus a 20-day moving average. In essence, all you're really doing is looking at 2 weeks worth of data versus 1 month's worth of data, correct? So a 20-day and a 40-day moving average works out to comparing a 1 and 2 month viewpoint. Day traders can break down the use of multiple time frame analysis, such as a 15-minute period and a 5-minute period. Of course, 15 divided by 3 is 5, so it's divisible into each other. Now, using moving averages helps identify shorter-term and longer-term trends, and that's why we use multiple time frames. You use a shorter term against a longer term, and then you look for changes within those time frames. We can use them to also identify, as I mentioned earlier, support and resistance levels. If the market's in an upswing, then our moving average, we should be looking at it as a support target. Gee, look for the market to regress to the means. In other words, return back to the moving average. And there you can look to buy what I call the snapback approach. A lot of times we see these big, huge bar upswings, and people say, boy, I can't buy it up there. Or worse, they actually do. and then the market pulls back. And then just about the time they really should be getting long, that's when they bail out of the position, and sometimes worse, people reverse and go short in the hole. You'll use the moving average as a tool as support. So there's another way that we look at moving averages, looking at crossover features when two or multiple moving averages cross. And that can also help us identify, based on where price moves too far from one moving average versus another, that can give us a clue whether we're a little overbought or a little oversold. And that's what I just referred to as departing or regressing to the means. There's two terms that you've probably heard before in many other seminars or webinars. If not, we have a dead cross, which has a negative or bearish connotation, and that's generally when we get a sell signal, and it refers to when the shorter-term moving average crosses beneath the longer-term moving average. A golden cross or a bullish or positive crossover is when the shorter-term moving average crosses above a longer-term moving average. Now look at this situation here, again, studying the BPX. And what's interesting is that we've taken this as a daily chart. This is a daily chart, number one, going back since mid-April, all right? So again, we were looking at a dead cross. Notice that our relationship, something didn't line up with the circles, but two ranges close and are trading entirely beneath both moving average values. We come to predicted support, but let's go over what we just discussed. Would you want to be buying right now? Obviously not. We have no reason to get long this index right now, do we? Based on a technical point of view. Now, as the market ends this week, notice that the pivots adjust themselves and give you an idea that it's predicting that next week we have targeting lower highs and lower lows. And guess what? From that week to the next week, the market went down. From the close of this week, the pivots, again, self-adjust, and guess what? They give us an indication that this might be the potential low, which happened to be the case. It also said, look for lower highs again for the following week. And again, the market went down. And again, and again. And all of a sudden, it's gone below our predicted support. It's below what it predicted to be, again, a bearish condition. But you want to know something? Look what happened. Two full bars above the moving average crossover. This would have been a great indication at this point to cover the short position. So the two-bar methodology with using the crossover, the dead cross here, and using the two-bar close method with the two-bar full range method help indicate a change in direction, including the two-period crossover moving averages there. So we have multiple ways of looking at the market. A, person's pivots help give us identification that the market condition was bullish and bearish, and then price to moving average relationship helped us uncover the value or trend strength or weakness, and in this case, weakness in the market. So this was showing that the dollar, as you can see, because again, we're using the ISE's British Pound FX Index, this shows that the dollar was remaining weak against the British pound. So as the dollar from 68 cents, we were starting to see it go down to almost 60 cents. Now, if you go over to Britain, that hurts, right? So we're losing value on the dollar versus the pound. And so I think that that's kind of the trend that we'll probably see continue towards year end.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.